So let's talk about something a lot of us think about, building wealth, especially over the long haul, for retirement.
Right.
How do you actually get there? Maybe you're just starting with like a small amount each month. It can feel pretty daunting.
It really can. But, the truth is consistency, even with small amounts, it can build into something really significant over time, decades even.
Yeah, that compounding effect.
Exactly. That's the magic. But it works even better when you combine it with a specific strategy,
Right.
something that really leverages that long-term potential.
And that's exactly what we're diving into today. We're looking at some source material. You brought us key bits from an article called Retirement Riches, Investing in Dividend ETFs.
That's the one. So the mission for this deep dive is really to unpack what this source tells us about one particular investment approach. It's about focusing on dividend stocks, specifically through these things called ETFs, exchange-traded funds.
Okay.
And the article really zeroes in on one specific example, the Schwab U.S. Dividend Equity ETF. The ticker is SCHD.
SCHD. Got it. So we're exploring why the source likes this strategy and this fund in particular.
Precisely. Why this approach might be powerful, according to the article.
Okay, let's unpack it then. The source makes a pretty strong case right off the bat for why dividend stocks are important, especially the ones that keep increasing their payouts. What does the article say about their track record?
Well, it points to some pretty striking historical data. It cites figures from Hartford Funds and Ned Davis Research. And basically, over the last 50 years.
50 years, okay.
Yeah, a long time. Companies that grew their dividends delivered an average annual return of 10.2%.
Wow, 10.2% average. Just for the dividend growers, how did companies that didn't pay dividends do?
That's where the contrast really hits, the non-dividend payers. They averaged only 4.3% over that same 50 years.
Only 4.3, so more than double the return on average for the dividend growers.
Exactly. That's what the source highlights, a really significant performance gap. It really underscores the historical edge, of sticking with companies that pay and consistently raise their dividends.
That's a huge difference over the long term. Okay, so the article establishes the what dividend growers, then it moves to the how. How does the source suggest an everyday investor can, get into the strategy easily?
Well, the source suggests that one of the simplest ways is through a dividend-focused ETF, like we mentioned.
Right, the ETF route.
Yeah. Instead of you having to pick individual stocks, which can be tough.
And time-consuming.
Time-consuming, exactly. An ETF gives you instant diversification across a whole bunch of these kinds of stocks all at once.
Makes sense. And the article specifically flags SCHD as like a top option here. So what's its approach? What's it trying to do? Which index does it follow?
Okay, so SCHD tracks the Dow Jones U.S. Dividend 100 Index. And the goal of that index, according to the source, is to measure the performance of stocks that have higher dividend yields. But, and this is key, they also need a strong track record of consistent growth in those dividend payments over time.
So it's not just yield hunters, it's yield plus growth. That ties back to that performance data you mentioned.
Exactly. It's about the sustainability and the growth trajectory of the dividend, not just the snapshot today.
So how does this index actually pick the companies? What does the source say about the criteria?
The source mentions it screens companies based on several dividend quality characteristics. But the main things it looks at are the current dividend yield and the company's 5-year dividend growth rate.
Yield and growth rate. Got it. And the result is this list of 100 companies. How does the article describe them?
It basically characterizes them as representing, 100 of the best dividend stocks in the country, specifically the ones that fit that profile of both decent yield and proven dividend growth based on the source's view.
Okay, let's get into the numbers the source provides for SCHD itself. It mentions data after some annual reshuffling they do in March. What did the fund's holdings look like then?
Right, after that reconstitution. The source reports that the average yield of the stocks held in the fund was 3.8% at that point.
3.8%. And what about their dividend growth history?
Pretty strong. On average, those companies had grown their payouts by 8.4% per year over the previous 5 years.
Okay, 3.8% yield, 8.4% 5-year growth. Let's put that in context, like the source does. How does that stack up against, say, the broader market, like the S&P 500?
Yeah, the source draws that comparison. It highlights a pretty clear difference. The S&P 500's yield at the time was significantly lower, around 1.3%.
1.3% versus 3.8%. Wow, so SCHD's holdings, on average, offer nearly triple the yield.
That's right. nearly triple the income based on that current yield.
And what about the dividend growth comparison?
Also better for SCHD's holdings, according to the source. The S&P 500's average 5-year dividend growth rate was around 5%. SCHD's holdings averaged 8.4%.
So higher starting yield and a higher average growth rate in those dividends compared to the average S&P 500 stock.
Exactly. That combination is really central to the strategy the article is exploring.
Okay, to make this less abstract, the article mentions a couple of the big companies in the fund. Can you give us some examples?
Sure. The source points to Coca-Cola, ticker KO. It notes Coke is the second largest holding.
Ah, Coke. Everyone knows Coke.
Right. And what's really remarkable, the article highlights, is its dividend history. 63 consecutive years of increasing its dividend.
63 years. That makes it a dividend king, right?
It absolutely does. Very rare company. The source notes they just increased it again earlier this year by 5.2%. And the scale is just huge. They paid out $8.4 billion in dividends last year alone.
Oh, wow.
And over $93 billion since 2010. The article suggests that Coke's strong cash flows put it in a good position to keep that streak going. Its yield currently, per the source, is around 2.8%.
Okay, 63 years is impressive. Any other big names the source mentions?
Yeah, it also highlights Chevron, CVX, another top holding.
An energy giant.
Yep. And its history is impressive, too. 38 straight years of dividend increases. And the source makes the point that this includes navigating some really tough downturns in the oil market. Shows resilience.
Right, that resilience seems key for this kind of index. What about Chevron's recent dividend growth?
The source says it's had a peer-leading growth rate over the last 5 years, and it's projecting another 5% hike in 2025. They expect to add something like over $9 billion to annual free cash flow by next year.
Wow.
Which the article suggests really fuels that potential for future dividend growth. Its current yield is higher than Coke's, around 4.7%.
Okay, so these examples, Coke, Chevron, they really paint a picture of established cash-generating companies. Given this focus, how has SCHD itself actually performed? What does the source say about its track record?
It's been strong since it launched back in late 2011. The source states it has generated an average annualized total return of 12.2% since inception.
12.2% per year on average. That lines up pretty well with that earlier historical data on dividend growers, doesn't it?
It does, and the article is pretty clear about what's driven that strong performance.
Which
a major factor has been the growing dividend payouts from the companies it holds. As those underlying companies raise their dividends year after year, that contributes directly to the total return and the income distributed by the ETF itself. It creates this sort of generally rising stream of income over time.
Okay, so this brings us to the big what-if question the source explores. What could this kind of strategy potentially mean for someone investing consistently, like month after month over a really long time? The article gives a hypothetical.
Right, it does. It runs a scenario just to illustrate the potential power here. It asks you to imagine investing, say, $250 every month.
Okay, $250 a month, manageable for many.
Yeah, into a fund that manages to achieve that same historical 12.2% average annual return. And this is crucial. You reinvest all the dividends you receive along the way. You do this for 30 years.
30 years. Okay. $250 a month, 12.2% return assumed, reinvesting dividends. What does the source project that could grow into?
Well, according to the article's hypothetical calculation, that consistent investment could potentially grow to a total value of over $923,000.
Whoa. Over $923,000 from just $250 a month. That really shows you the power of compounding in time based on that historical rate.
It really does. And the source doesn't stop at the total value. It also looks at the potential income that Nest Egg could generate.
Ah, the dividends.
Exactly. Based on the fund's dividend yield over the past 12 months, which the source puts at around 4% at the time.
Okay.
That potential $923,000 investment could throw off nearly $37,000 in annual dividend income.
Nearly $37,000 a year just from the dividends. The source calls that a nice chunk of change. You can see how that could really help cover expenses in retirement.
Absolutely. It paints a picture of potentially building not just a large pot of money, but also a substantial income stream from those, relatively modest monthly savings.
That combination, the capital growth potentially fueled by rising dividends, plus the growing income stream itself, that seems to be the core potential benefit the source is emphasizing.
That's the idea it presents, yes.
Now, we absolutely have to include the caveats, the warnings. What does the source make sure to tell listeners?
Yes, very important. The source is crystal clear. There are absolutely no guarantees. None.
Right.
There's no guarantee that SCHD or any investment will keep delivering returns like that 12.2% historical average. And there's certainly no guarantee it will produce income at its current rate in the future.
Standard disclaimer, but crucial. Past performance doesn't guarantee future results.
Exactly. You always need to remember that when looking at historical numbers or these kinds of hypotheticals.
Definitely. But stepping back, what's the fundamental reason, according to the source, that this fund, SCHD, has shown such a strong track record so far? What's the underlying logic?
It really comes back to the philosophy of the index it tracks and the kinds of companies it ends up holding. The source reiterates that the focus is squarely on investing in businesses that have a history of paying sustainable dividends.
Sustainable.
And, crucially, steadily rising dividends. The article concludes that these types of companies, historically speaking, have often been the ones to produce strong total returns over the long run. And that's reflected in SCHD's performance since it started.
So wrapping this up, what does this deep dive into the source material really mean for you, the listener? The main takeaway presented here seems to be this. Based on the information and the history the article lays out, using a strategy like consistent monthly investing in a diversified ETF focused on high-quality, growing dividend stocks with SCHD, as the specific example here, could potentially, over the long term, help turn even modest savings into a much larger future nest egg.
Yeah, it's presented as a compelling illustration how focusing on solid businesses, the ones committed to returning capital and growing it, could potentially build significant wealth and income over decades.
It really shines a light on the potential power of being focused, being consistent, and thinking long-term based on what this source described.
And, maybe a final thought to leave people with, drawing from this, just how much can that consistency, that discipline of investing regularly, combined with the power of reinvesting dividends from companies that keep raising them?
Yeah.
How much can that truly build over decades?
Yeah.
And maybe even thinking about the qualities, like that resilience we saw with Coke and Chevron, what allows companies to consistently grow dividends through thick and thin. How might exploring that inform your own understanding of what makes a good long-term investment?
Definitely food for thought as you consider your own financial journey. Well, thanks for joining us for this deep dive into the source material today.